Oh, I haven't bored you enough yet, huh? All right, well, let's continue then. I'm David Worley, and now we're going to talk about PMI. What is PMI? Well, it's not good. Let's talk about it, though. PMI means private mortgage insurance. In the United States, whenever you take out a loan, if you put less than 20% down, you're going to have PMI as part of your house payment. PMI is literally an insurance policy that you're paying for to protect your lender against you defaulting. Let's let that soak in. Yeah, you're paying for an insurance policy so that if you ever don't pay your mortgage, the PMI company has to pay the first 20% of your mortgage off to the lender. So the lender is protected against you defaulting. That's what PMI is. It does not pay your house off if you get sick or if you die or anything like that. It's not insurance in a traditional sense that you think it is. It does not protect you in any way, shape, or form, but it does allow you to borrow money at the comfort of the bank without 20% down. Now, PMI can be a lot or it can be a little. The more money you borrow, the higher your PMI is going to be because it's based on the balance, but it's also based on how much money you put down. So, I did a little example here. You might be wanting to know how much money are we talking about, right? Okay. Well, if you bought a house for $150,000 and you put down 5% on a conventional loan, your PMI is going to be $92.62 a month. So that gives you a ballpark figure. If you did the same loan and you put down 3% on an FHA loan, which is a whole different animal, the PMI, or MIP as the government calls it, is going to be $67.72. What's the difference? All right, let's talk about that for a minute. When you talk about PMI, it's a private thing, private mortgage insurance that any bank in the country is going to take out to protect them from you defaulting. When you take out an FHA loan, you're not, though that PMI company is not insuring the loan, the government is insuring the loan. With an FHA loan, the government is not loaning the money. It's still from a normal run-of-the-mill, everyday corner mortgage company, but your loan is guaranteed by the federal government. So if you ever default on it, they have to pay the MIP off on the bank. The bank still gets their money, but you need to understand, in either case, when you sign up for a loan, that MIP is going to stay in place until you've paid the loan down by 22% of its original amount by payments. So, generally speaking, if you take a conventional or an FHA and you put down as little as you can, that PMI is going to stay on your payment for about 11 to 13 years. That's kind of forever for most people, okay? You can get rid of it faster if you pay the loan down faster, which is always a good thing to do. And you need to understand that when the private mortgage insurance is made by banks, it's a private thing. When the government does it, it's called mortgage insurance premium. It's the very same thing. It's just whether or not it's guaranteed by the government or guaranteed by a private company. Okay? Now, you also need to know and understand this very clearly. The PMI does not benefit you in any way, shape, or form. It's evil, and you want to get rid of it as fast as you can. The way to get rid of it, if you have a lot of money, is to put 20% down and go conventional. Once you've hit 20% down, there is no PMI. On an FHA loan, that's not true. If you have 20% down or 50% down, you're still going to have MIP on an FHA loan. All these numbers and letters get me confused, but we'll muddle through the best that we can. So please understand that the more you put down, the less your PMI is. And your payment's going to be lower as well because you're borrowing less money. But that's about PMI and MIP. And I know I've confused you, and that's okay. Your lender will be able to straighten you out. Or come on in. I'll talk to you. See you later.